Welcome back to the Deep Dive, the shortcut you need to feel fully informed. We really appreciate you sending in that fascinating stack of sources on the Qatar property market, specifically looking at this high-stakes shift happening right now, after all the massive spending for the World Cup. So our mission today is really to analyze this pivot. We're moving beyond the, let's say, short-term speculative buzz of 2022 and focusing entirely on where durable long-term capital should probably align now. It's less about a quick flip based on hype. It seems much more about structural economic diversification.
That's exactly the key distinction, yes. The narrative before was, well, it was dominated by established luxury spots like West Bay, wasn't it? But if you're really looking for genuine future growth, these sources are pretty clear. The opportunities now seem concentrated in strategically emerging districts. It's not just a map change, it's an intellectual shift, too. We really need to grasp the governmental mechanisms, the specific policies, the infrastructure commitments that promise stable structural growth. So this deep dive, it's about giving you a data-driven blueprint, identifying where capital can directly support and, frankly, benefit from Qatar's National Vision 2030.
Okay, let's unpack that shift then. Why this transition? Going from these huge state-led mega projects that really define the pre-2022 era to a model that now seems to rely much more on investor-led demands to sort of professionalize the market?
Well, the driving force is, I think, economic maturity. Historically, the state shouldered most of the risk, the development debt. This pivot towards investor-led demand, it's a crucial step. It helps control public debt, transfers risk to the private sector. It really signals a confidence, I think. Confidence from the government that the market can maybe stand on its own feet now. And actually, the core asset here isn't just land or concrete anymore. It's the governmental stability itself, underpinned by that long-term strategic vision. Like Dr. Puyan Gamari notes in one of the sources you sent, this Vision 2030 framework. He calls it the strongest non-tangible asset.
Non-tangible asset.
Yeah, supporting the whole real estate sector. It's the promise, really, that the infrastructure, the rules, the economy, they're all heading in one predictable direction.
Okay, so if Vision 2030 is the foundation, where should investors actually build? You mentioned this pivot is explicitly about attracting long-term expat professionals.
Yeah.
People in what? Finance, tech, education, the non-oil sectors.
Precisely. So the focus has to be hyper-targeted. Investors need to pinpoint the zones where two critical things converge. One, favorable government rules for foreign ownership, and two, existing integrated smart city infrastructure, the kind designed specifically to attract and keep that high-earning expat workforce. We're not just, building apartments anymore. We're building the whole ecosystem for Qatar's future economy.
Right, and this is where the geography gets really interesting. The sources seem to lay out different value propositions for these new hotspots. I see three distinct categories emerging, appealing to different investors, different strategies. Let's start with Lusail City. The sources are calling it the gold standard, positioned as the future business hub, the benchmark for smart living.
Lusail is unequivocally aimed at the top tier. We're talking high net worth individuals, major corporate HQs. They're looking for those premium waterfront assets, but also the state-of-the-art infrastructure. And critically, office spaces that are ESG compliant.
Okay, ESG compliant. Just quickly for everyone listening, environmental, social, and governance. In this context, that means real estate meeting global sustainability standards, which is becoming mandatory for big institutional investors.
Exactly right. Lusail is really pricing in global capital requirements, not just sort of local preferences. But the key policy piece making it such a magnet is its designation as a freehold zone.
Ah, freehold. That's huge in the Gulf context, isn't it?
It's massive. For listeners maybe not familiar, freehold means you own the land and the property outright, direct ownership, not just a long-term lease. This policy shift is absolutely designed to attract long-term wealth migration. It guarantees legal clarity, it secures the highest long-term capital appreciation potential, and crucially, ownership there often grants eligibility for a residency permit. So it links investment directly to immigration policy.
Okay, completely different model then. Msheireb Downtown Doha feels less like a brand new city, more like a careful cultural revival, a boutique vertical city.
Msheireb definitely offers a different kind of opportunity. It's smaller scale, yes, but potentially high yield, particularly in, say, boutique hotels, specialized commercial offices. Its success really lies in what urban planners call placemaking.
Placemaking, yeah, sometimes feels like a buzzword. But the sources suggest Msheireb genuinely achieved it. What makes its occupancy so resilient?
Well, it created a real walkable urban center, not just, a bunch of buildings. It attracts startups, SMEs.
SMEs, small and medium enterprises.
Exactly, because it offers flexible, central, tech-savvy workspaces, all wrapped in this culturally authentic yet modern vibe. That proven foot traffic, the density, it ensures pretty resilient occupancy rates, even if the absolute scale is smaller than, say, the behemoth of Lusail.
Right. Okay. And then the third category, the value-add suburbs, Al Dayan and Al Wakra, transforming from just commuter towns into investment centers themselves.
Yes, these represent a sort of democratization of the investment opportunity outside the really dense Doha core. The growth driver here is primarily strong land sales and more affordable residential development. They benefit massively from two things. One, much better infrastructure links now, and two, what we call spillover demand.
Spillover demand. So as the city center gets pricier, people look outwards.
Precisely. The workforce needs places to live. These areas let investors capture a different demographic, offer that vital, affordable housing component, which, you need to sustain the growth of the professional class working in Lusail or West Bay.
So we've mapped the where,
Yeah.
the geography. But if you're an international investor eyeing a high-value asset in Lusail, or maybe even a piece of Msheireb, how do you actually get access? This must take us beyond just bricks and mortar, right, into a financial tech layer.
Exactly. There's a parallel maturation happening in financial innovation. The Gulf region, and Qatar's part of this, is rapidly adopting PropTech, property technology. It mirrors that broader GCC trend towards integrating things like blockchain and asset tokenization into how property deals are done. This is absolutely key to internationalizing the market, attracting new types of capital that maybe couldn't participate before.
Tokenization.
Yeah.
Okay, that sounds like the magic bullet for liquidity. But tokenizing big, traditionally illiquid assets like buildings, surely that relies entirely on regulatory trust. Are the sources showing concrete rules being put in place to protect people who might buy a fraction? Or is it still speculative?
That's the critical question. And yes, the sources do confirm Qatar is actively working on establishing these regulatory norms. They're drawing precedents from platforms that already digitize other safe haven assets like precious metals. You mentioned Gold earlier as an example. The next logical step is implementing this for large real estate assets in key zones like Lusail, like the Pearl. Maybe think of it this way, just for simplification. Traditionally, you might need, say, $10 million to buy a whole floor in a Lusail tower. Tokenization could allow that single asset to be digitally divided into, I don't know, maybe 200,000 individual tokens. So now you could potentially buy a digital fraction of that floor for, say, $50,000 and trade it almost instantly on a secure digital platform.
Wow, okay. The impact seems clear then. This digital layer could drastically lower the entry barriers for international investors, letting them participate in high-value projects without needing huge upfront capital. And that should significantly boost market liquidity, right?
Absolutely. Which brings us back to navigation. In this complex, increasingly digitized landscape, how do you find the right opportunities? How do you make timely, data-driven decisions? This is where platforms like the A-Lend platform become, well, essential conduits. They act as a global hub. They give developers tools to showcase properties to this new, tech-savvy investor audience. And maybe more importantly, they offer the necessary analytical insights, often AI-driven, to match international demand with the right locations. Whether that's the emerging suburbs or the premium Lusail assets, matching demand with spots that promise long-term sustainable value aligned with Doha's whole urban expansion plan.
Okay, this is incredibly insightful. So if you've absorbed all this information and you're looking to act on this transition in the Qatari market, let's try and distill the specific actionable steps from the sources. We need a clear, final roadmap for investment strategy.
Right. Based on the sources, we can identify 4 critical strategic pillars for any forward-looking investor. First, and maybe most fundamentally, focus on freehold zones. As we discussed, this is foundational. It guarantees that legal clarity, the direct foreign ownership, and it aligns perfectly with those residency policies aiming to attract long-term capital. Your primary targets for this strategy have to be Lusail and the Pearl. They offer the highest potential for long-term capital growth, coupled with that legal security.
Makes sense. Pillar number 2, integrate PropTech platforms. This isn't just a nice to have anymore, is it? Seems mandatory for efficiency and access.
It really is becoming mandatory. You need access to AI-driven market analytics, faster transaction capabilities. Leveraging these platforms now gets you ready for that tokenization future we talked about.
Yeah.
It ensures you can enter or maybe exit a position quickly. You want to capture that appreciation curve that comes with deliberate urban expansion. You need the tools.
Got it. Third pillar, prioritize mixed-use assets. We saw the value of this when we talked about Msheireb.
Yes, investing in mixed-use developments provides crucial diversified income streams. You're combining residential rents, commercial leases, maybe retail revenue. This gives your portfolio resilience. If the commercial office market slows or residential rents dip temporarily, you're hedged. It basically hedges your bets while catering to the whole ecosystem of that new workforce you're trying to attract.
Okay, and the final pillar, number 4, addressing that global requirement for responsible capital. Monitor green building credentials.
This is essentially about future-proofing your assets' value. You need to look specifically for properties with GS certification.
GSF.
The Global Sustainability Assessment System. It's Qatar's specific rating system for green buildings. Having that certification ensures lower operational costs, usually higher tenant retention because tenants want sustainable spaces now, and critically, it guarantees alignment with those global ESG investment mandates. If your building doesn't have these credentials, you risk alienating the largest pools of institutional capital down the line. It's becoming non-negotiable for many.
This has been a really thorough deep dive. We've moved beyond the buzzwords, I think, covered the economic reasons for the strategic pivot, the distinct geographies of these new investment hotspots, Lusail, Msheireb, the value-add suburbs, and crucially, the technological framework, focusing heavily on PropTech and tokenization as the keys for international access and liquidity.
And if we connect all that to the bigger picture, the competitive advantage in this evolving Qatari market, it seems to belong squarely to the sophisticated investor, the one who leverages technology effectively to analyze and then enter these emerging districts early. They're the ones who will successfully transform what were, geographically separate raw assets into digitally accessible, economically resilient portfolio components.
So the integration of technology, especially tokenization, aims to boost liquidity by breaking down those large, expensive assets into smaller pieces. This really raises an important final question for you, the global investor listening today. When ownership can be fractionalized like that, instantly traded, bought digitally in small units, does the very concept of a long-term real estate investment fundamentally change? Something to think about.